Bitcoin's security model has a structural challenge that becomes more acute with every halving. The block subsidy that pays miners to secure the network decreases by 50% every 210,000 blocks, approximately every 4 years. Before 2023, transaction fees represented less than 2% of miner revenue in most periods, meaning that the Bitcoin network's $20 to $30 billion annual security budget was almost entirely dependent on a subsidy that mathematically must approach zero by approximately 2140. The emergence of Ordinals in early 2023, followed by BRC-20 tokens and other non-financial use cases for Bitcoin block space, changed the fee market dynamics dramatically. For the first time in Bitcoin's history, transaction fees regularly competed with and occasionally exceeded block subsidy as a component of miner revenue. In May 2023, transaction fees exceeded block subsidy for a full day, a Bitcoin network first that demonstrated the potential for a functioning fee market. For institutional Bitcoin investors, the fee market evolution is not an abstract technical question but a fundamental security analysis issue. A Bitcoin network with insufficient miner revenue to maintain adequate hash rate security becomes less valuable as a store of value. Understanding the trajectory of Bitcoin fee market development is essential for long-term institutional valuation of Bitcoin as a financial asset. The Bitcoin miner revenue formula reveals the fundamental tension at the heart of Bitcoin's long-term security model. The block subsidy provides a predictable, mathematically certain revenue stream that declines on a fixed schedule. Transaction fees provide a variable revenue stream that depends on network demand for block space. The combination of the two must generate sufficient USD revenue to compensate miners for the capital and operating costs of maintaining network hash rate. Bitcoin price appreciation has historically been the primary mechanism compensating for halving-driven subsidy reductions. Each of the previous 3 halvings was followed by significant price appreciation that substantially increased USD miner revenue even as BTC subsidy per block decreased. The April 2024 halving reduced block subsidy from 6.25 to 3.125 BTC per block. If Bitcoin price doubles following the halving, USD miner revenue per block is unchanged despite the 50% subsidy reduction in BTC terms. The long-term structural challenge is that price appreciation cannot indefinitely compensate for subsidy decline. By approximately 2032 and 2036, block subsidies will fall to 0.78 and 0.39 BTC per block respectively. Unless Bitcoin price grows to levels that seem implausible on conventional financial analysis, or unless the transaction fee market develops substantially, Bitcoin's security budget will face increasing pressure in the 2030s and beyond. The Bitcoin halving timeline reveals a consistent pattern of fee market underdevelopment relative to the mathematical certainty of subsidy decline. For the first 3 halvings, transaction fees remained below 5% of miner revenue in most periods, with temporary spikes during congestion events but no sustained fee market development. The subsidy decline was fully compensated by Bitcoin price appreciation. The 2023 Ordinals development represents the first genuine structural change to Bitcoin's fee market. By creating non-financial demand for Bitcoin block space, Ordinals demonstrated that Bitcoin's limited block space can command meaningful fee premiums when demand is sufficient. The May 2023 day when fees exceeded block subsidy was a proof-of-concept demonstration that a functional fee market is technically achievable on Bitcoin. The critical uncertainty for institutional investors is whether Ordinals-driven fee demand is a structural feature of Bitcoin or a temporary phenomenon dependent on speculative activity in BRC-20 tokens. If Ordinals and subsequent non-financial Bitcoin block space users create durable fee market demand, Bitcoin's security budget path is substantially more favorable than a subsidy-only analysis would suggest. If Ordinals activity is primarily speculative, the fee market development remains an unresolved structural challenge. The Bitcoin fee revenue data demonstrates the high volatility and cyclical nature of fee market income relative to block subsidy. The dramatic spike to 100% fee dominance for a single day in May 2023 illustrates both the potential of the Bitcoin fee market and the danger of relying on a single data point. Sustained fee contributions in the 10 to 15% range post-Ordinals represent a meaningful improvement from the sub-2% historical baseline, but remain insufficient to compensate for the mathematical certainty of subsidy decline. For institutional miner analysis, the fee market volatility creates significant revenue modeling challenges. Miners must underwrite capital expenditures on ASIC equipment based on 3 to 5 year return expectations, but the fee component of revenue can fluctuate by 10x or more within a single quarter depending on block space demand. The revenue model must either conservatively exclude fee revenue from base case projections or explicitly model fee market scenarios with appropriate probability weights. The 2024 post-halving period provided the most instructive data for long-term fee market analysis. The April 2024 halving created the first halving event in the Ordinals era, allowing direct observation of whether fee market development could offset subsidy reduction. Early data suggested that Ordinals and Runes activity created meaningful fee buffers during the halving period, but sustained data over multiple market cycles is needed to draw structural conclusions. Ordinals represent a philosophical shift in Bitcoin's block space use cases that had significant implications for the fee market debate. For the first time, Bitcoin block space was being demanded for reasons unrelated to financial transactions. Digital art collectors paid premium fees to inscribe NFT-like artifacts onto Bitcoin's blockchain, creating a new buyer class for Bitcoin block space with different price sensitivity and demand characteristics than financial transaction users. BRC-20 tokens amplified the non-financial block space demand by creating a speculative asset class native to Bitcoin. During peak BRC-20 activity periods in 2023, the volume of BRC-20 token transfers exceeded regular Bitcoin financial transactions by a significant multiple, creating genuine fee market pressure that pushed average transaction fees to multi-year highs. The speculation in BRC-20 tokens was demonstrably creating the fee market development that Bitcoin economists had theorized about for years. The Runes protocol launched at the 2024 halving block was designed to create more efficient Bitcoin-native token infrastructure. By replacing the UTXO-intensive BRC-20 standard with a more efficient UTXO model, Runes aim to maintain non-financial block space demand while reducing the negative externalities of BRC-20 activity on regular Bitcoin transaction users. Whether Runes successfully maintains fee market demand over multiple market cycles will be one of the most important data points for long-term Bitcoin security budget analysis. The Bitcoin security budget risk scenarios represent genuine long-term valuation considerations that institutional investors with multi-decade investment horizons must explicitly model. These are not near-term risks. The block subsidy remains meaningful through the 2030s, and Bitcoin security budget is not at risk on any near-term timeframe given current hash rate and price levels. The long-term risks become material in the 2040s and beyond, when block subsidies will have declined to levels that require either massive Bitcoin price appreciation or robust fee market development to maintain the current security budget in USD terms. The difficulty is that 2040 scenarios are beyond the investment horizon of any institutional analysis, but the structural trajectory is knowable and relevant to institutional stores of value claims about Bitcoin. The most intellectually honest institutional position is to acknowledge that Bitcoin's long-term security budget depends on fee market development that has not yet been demonstrated at the required scale, while recognizing that the current 10 to 20-year investment horizon is not materially exposed to this risk given current network security levels. The security budget question is a long-term monitoring variable for institutional Bitcoin investors, rather than an immediate portfolio risk. The Bitcoin fee market analysis provides institutional investors with the analytical framework to evaluate one of the most frequently cited long-term criticisms of Bitcoin as a store of value. The security budget question is a legitimate structural consideration that deserves explicit analysis rather than dismissal, but the current evidence suggests it is a monitoring variable for long-term holders rather than a near-term portfolio risk. The Ordinals era has provided genuinely new data that improves the long-term security budget outlook. Before 2023, the Bitcoin fee market was almost entirely dependent on financial transaction demand that was subject to Layer 2 competition from Lightning Network. The demonstration that non-financial block space users can create significant fee revenue from buyer types uncorrelated with financial transaction volumes opens a new revenue pathway that was not part of the pre-Ordinals security budget analysis. For institutional investors, the appropriate analytical conclusion is to monitor fee market development as a key Bitcoin network health metric, weighted appropriately in long-term valuation models, and maintain positions sized to be appropriate even if the security budget evolution unfolds less favorably than the base case. Bitcoin's near-term value proposition as a store of value and inflation hedge is not dependent on fee market resolution, making the security budget question a long-term variable rather than an immediate investment constraint.